If you're a real estate agent that's looking to start investing on your own and build a portfolio, but you're not sure where to start or how to run numbers, this video is for you. My name is Jared Davis and I run Mega Agent Academy, a YouTube channel that's designed for agents to not only get started in their sales journey, but build a mega business and ultimately build wealth for the future. So if you haven't already, please like and subscribe for all of our latest videos and trainings. We also do a Monday live coaching call on Zoom at 1 p.m. Eastern. You can catch the details for that in the description below. You can also reach out to me on Instagram, Jared Davis RE, if there's anything that I can do to help you in your real estate business. But what are we going to learn about today? Well, by the end of this video, hopefully, you will have a grasp on how to analyze rental deals, whether you're dealing with single family or whether you're looking to start getting into multifamily. Maybe it's duplexes, triplexes, quads, or even bigger. I have a portfolio of over 300 doors that I've built over the last 6 years, and I've done everything from single family to small multi like quadplexes, all the way up to facilities with anywhere from 40 to almost 100 units. So ultimately, we want you to understand what are the expenses that you have to keep in mind when you're dealing with analyzing a rental deal. What are the percentages that you can look to be paying off to just different expenses and things like that? How much profit do you want to be making? How much money are you going to have to put down? That's what we're going to talk about today, because I find a lot of real estate agents just don't know where to start on that piece of it. They're not really sure how much money they should be making on their money. And maybe you're not even a realtor. Maybe you're just a real estate investor or someone that wants to be a real estate investor. We find the same thing. I talk to investors on the phone a lot. People call me for help. They call me when they have capital that they want to deploy, and you get answers all over the map as to what people want to make on their money, what they think is a good cash on cash rate. So that's what we're going to talk about today. How do I analyze my deals? So first things first, what are the overall expenses that you have to deal with when you're dealing with purchasing a rental property? And what is the average percentage, whether you're dealing with maybe a single family or a multifamily? Well, the first one that I want to talk about is what's called vacancy loss. What people do not keep in mind most of the time, if they haven't started building a portfolio or they haven't owned a rental yet, is the fact that you have to turn that property over. So at least once in a while, that property has to be vacant. At some point, your tenant is going to move out. I want to say the average vacancy turnover is like 50%. So a lot of the time, probably at least half the time that you have a lease run out, that tenant's going to vacate. So while that unit is vacant, it's not bringing in any money, but you're still having to pay the expenses. You're still having to pay the mortgage if there's a debt service in place. So you have to think about what is that percentage. So if you're taking notes and you're writing down all of the percentages that you're gonna have to keep in mind on what's coming off of that rent on a monthly or annual basis, a good rule of thumb for vacancy loss is gonna be about 5 to 8%. Now, 8% is going to be more notable and more likely if you just have a single family house. That is because if your single family house loses its tenant, then you are 100% vacant. You have no other money coming in. So single families can be great for a lot of different things, but it can be tough when you start your journey into this portfolio building, because again, when you just have one door, one vacancy is 100% vacant. If you have 100 doors, then one vacancy is only 1% vacancy. So keep in mind, on a single family house, it's over 8% in vacancy loss alone if your property is vacant for just 1 month out of the year. And that's pretty reasonable on a turnover. That's providing you get them out, you fix the property up, you market it, and you get it released within 30 days. Now, again, as you get into bigger units, multi-units, that number is gonna come down a little bit because your turnovers are gonna be mixed. I have, most of my buildings are 48, 52, 60 units. Buildings like that, if we can maintain maybe a 6% vacancy across the board, that's pretty good. If we can do like 5 to 6%. So keep that in mind. Now, what's the other thing that you have to keep in mind? Well, we're talking about vacancy loss. So what happens when something goes vacant? Well, we have turnover cost. Now, this is going to depend very much on how new your units are. Are they class A's, B's, or C's? But really, we try to shoot for about 3 to 4% in just turnover cost on each unit. Now, I want you to think about this for a second. What do you want to rent out? What do you want to own? Because if you have a brand new new home or an expensive home, or maybe a higher end apartment building that's class A, that means there's granite and quartz and it's newer construction and less to maintain and less to do, you're probably going to have higher end rents, which means you likely may not have as big of a turnover problem. As you get into the B class properties, these are properties that maybe they're not in an A class area, maybe they're more builder grade appliances, builder grade kitchens, maybe some more carpet versus maybe hardwoods or luxury floors, but still command decent rents. And then you have your C class properties. These are your properties that typically are going to be high turnover, maybe Section 8 government rentals, maybe a lot of bad maintenance, bad management, things like that. So keep in mind that percentage is going to go up if you have a C class property versus an A class property. And almost everything we're talking about here, you can just bet that it's going to go up as you move from A to B to C. So you got your turnover. The next thing you have to think about is what's called CapEx. That's capital expenditures. And your capital expenditures are really just things that have to be ongoing with the building or house as far as maintenance goes. So you can think issues with siding, you can think window replacements, HVAC, roofs. These things, again, no matter whether it's a single family home or a multifamily, these are typically higher cost items. And while you may have a single family home that's newer and have almost no CapEx for 2, 3, 4 years, the problem is when you lose that HVAC unit or when you lose that roof, it could wipe out all of your profits for the year. So it's not to say that this is going to happen every year, but it's going to happen occasionally, depending on what has to be done. So it's one thing you want to think about before you even buy a rental, right? Because you want to look at, am I going to have to replace the siding? Am I going to have to replace the windows? How old is the roof? How old is the HVAC? And even if it's in good shape, if this is a long-term rental, you want to be thinking about that. And the percentage you want to think about for that is going to be 5 to 10%. Again, 5% is going to be on the lower end as you start to stack units, as you start to grow the portfolio. But on a normal portfolio, a single family house, you're going to be probably closer to that 10% mark. So we talked about vacancy loss, we talked about CapEx, we talked about turnover. Just right there, we're at about 22 to 23% on the high end, but that's not all, because likely you are going to want to have somebody manage your property. Now, a lot of first-time agent investors, they think, well, I'm in the business, so I might as well just manage the property myself. I could own my own management company if I want. And while that's true, the way that I look at it is my rental portfolio is mailbox money. It is passive income that I don't have to do that much work for. But if I am actively managing, I'm the one that's going to have to fill when it empties out. I'm the one that's going to have to handle evictions if evictions happen. I'm the one that's going to have to draft the leases and paperwork. I have to take the calls when something goes wrong and they need a handing in. So what I would recommend is, even if you're starting off and you want to manage yourself, at least build management into your initial numbers. That way, if at some point your portfolio grows, you're able to hire a manager and not go into the red. In management, you might as well just bank about 10%. Now, as your properties get bigger, as you start getting more doors, if you're buying a bigger building, you could see that drop as low as 5 or 6%. But I find even the companies that are out there charging a lower percentage, 6, 7%, there's still going to be miscellaneous fees. They've got release fees, they've got application fees, they've got certain things that will get thrown in there depending on the company. Sometimes there's salaries, sometimes there's marketing. Whatever it is, make sure you check with the manager to see, is the fee I'm paying all inclusive, or are there gonna be more things that are tacked on? But I find that you're likely looking at about 10%. So let's do some math. On the high end, that's 10% plus 10% plus 8% plus 4%. So what is that? Well, that's 34% that you're looking at right off the top of your rents. So I want you guys to think about that, because so many people look at whatever it is, a gross rental number, and they say, okay, I'm gonna get $2,000 a month. That's 24 grand a year. If my mortgage is $15,000, then I'm good to go. The problem is when you take that 34% out, it's not okay anymore, right? You start losing money. So I want you to factor all of these things when you're analyzing the deal first and foremost. So what you're gonna do is you're gonna take the gross operating income, the GOI. That's how much money does this property bring in. And if you're analyzing deals, one of the first things you're gonna ask for is the rent roll. That rent roll is gonna be the scheduled rent. So if it's one unit, that's fine. It's just gonna show this is the rent every month. This is what it is every year. As you get into bigger units and bigger buildings, you want that rent roll because you understand that different units may be renting for different amounts. So you wanna see, okay, what are the rents at? Are they all the same? Could rents be raised? Are rents under market? What condition is each unit in for what it is renting for, right? These are all different little things that you can start looking into to make sure that you're analyzing your deals right, okay? The flip side to that is, in addition to getting that rent roll, another thing you want to ask for is going to be a T12. That is a trailing 12. It's essentially 12 months of overall income and expenses. If it's for multiple years, you could think about it like a P&L, a profit and loss statement. So you could say, hey, do you have a P&L for the last couple years or taxes or anything like that? But more importantly, if I'm in the middle of the year, I likely want a T12 because I want to see what's the building doing right now, but what's it done over the last 12 months? That's going to tell me kind of how it's operating. Have rents gone up in the last 12 months? Have they gone down? Were there a bunch of CapEx expenses 6 months ago, but they didn't say that because they're trying to sell it on the current numbers? All of these things are a factor. You don't want to do the math on 1 month and say this is what the building's going to do. So you want your rent roll, you want your T12. If you have your T12, you're going to be able to see how close all of these numbers play in. Is the vacancy loss within what you think it is? Is the CapEx what you think it is? Is the turnover what you think it is? Once you know all of that, the last piece of the puzzle is to figure out, are you paying cash for the building or are you financing? Now, I would recommend almost always taking on debt service because the benefits are huge. You're gonna have a bigger appreciation on the property because you're buying a bigger property with debt service. You're gonna have debt service pay down. So you're gonna have that pay down each month that's growing your net worth. And then you have a bigger property to depreciate and use bonus depreciation on. Now, we're gonna be doing a lot of videos on that coming up. And we actually have an entire course on, if you're a real estate agent, how to never pay taxes again by using a lot of these strategies. So if you're interested in that, again, DM me on Instagram. I'd love to give you the details on that. But once you have all of your gross income and you take your expenses out, now you have your NOI, your net operating income. And that NOI, what you're gonna wanna do now is whatever you need to finance, you're gonna go to mortgagecalculator.org or whatever mortgage calculator you like, and you're gonna plug in all of the terms, including your insurance, including your taxes, unless that was already on the T12 that you were sent over. If it is, keep in mind, don't put your insurance and taxes in there twice. You wanna take them out if you're already looking at a T12 that has that information in there. But if it's not, when you're calculating the mortgage, you're gonna calculate everything as it would be to get that monthly payment. You're gonna multiply that monthly payment by 12, and then you're gonna subtract it from the net operating income. But once you do that, you are now left with your actual net, because this is going to be your net after debt service. So if you have debt, this is what's actually going to be your NOI. And now you can see, is this the amount of money that I want to be making on this building? Now, how much should you want to make on the building? Well, for most of the properties that we purchase, we shoot to pay our investors about 8 to 10% cash on cash. So how do you get that number? Well, whatever your true net is, let's say it's $10,000 a year. You are then going to go to a calculator, you're gonna do $10,000, and then you're gonna divide it by whatever your down payment amount was. So if you do 10,000 divided by, let's say you put 100,000 down for easy math, it's gonna come back and it's gonna say 0.1, 10%. So that's a 10% cash on cash. So this is gonna help you analyze to know what you should be offering on deals. And don't feel discouraged if you're putting in offers and they're getting declined, because the reality is a lot of sellers are out of touch with what they think their properties are worth, or they're trying to sell it to an owner occupant or somebody that's not looking as an investor, or maybe a cash purchaser that just just wants to 1031 in and set it and forget it, and he's in a rush. He's got to find something. So take your time and stick to your numbers, but also keep in mind, if you can make an 8 to 10% cash on cash return, if you take the debt service, another thing you want to look at when you figure out the mortgage is how much is that mortgage paying down every single month? Because if you're paying off, let's call it $500-600 a month, that's another $6,000 to $7,200 in equity gain per year you're getting. You also want to look at what's the appreciation of this property? So what's the average appreciation of properties in your area? You want to look that up, because if it's a $300,000 house and you're doing 3% appreciation annually, well, that's $9 grand on year one. So when you start adding in that pay down, 6, 7, 8 grand, you add in your equity gain, 9 grand, you add in your cash flow, 10 grand. Now you're making about $26,000, $27,000, $28,000 a year on that $100,000. And again, you're not reaping that gain up front, but when you start looking at the overall picture of, okay, if I hold this property for 5 or 6 years and then sell it, what's it look like? That total number is what's called your IRR. That is an internal rate of return. So you have your annual cash on cash, and then you have your IRR. What is this thing gonna make me on my cash over this whole run when I sell and it's all combined? So keep that in mind. The last bit that I'll throw in, because I mentioned on this that we're gonna be doing a course on trying to avoid taxes as a real estate agent. How do you legally get out of the entire or giant tax debts that we have? Well, we're what's called real estate professionals by the tax code. So talk with your CPA, make sure it falls in line. But if you already own a rental, you may have not done a cost segregation study on it or a bonus depreciation study on it. And if you didn't do that, you lost out big time, because essentially what that lets you do is take the property and take anything that's going to depreciate faster than the normal depreciation schedule. And if you're buying a multifamily building or you're buying a single family house, the government lets you depreciate that property over 27.5 years. So if you spend 275 grand on a property, you have about a $10,000 write-off every single year that can go towards your rental income and your real estate income. But what's amazing is if you do a cost segregation study and a bonus study, they'll take and try to get about 1/3 of that value in things that depreciate quicker: your HVAC, your roofing, your windows, your appliances, your lighting, things like that. And whatever that number comes out to, you can write it off on year one, which means if you're doing all the math and you get your cash on cash, you analyze your deal, you're like, the cash on cash works. And then you look at the appreciation, you look at the pay down, you're like, oh, that works pretty good as well, right? You add that bonus depreciation on top of that, and on a $300,000 house, you may have a $100,000 write-off on year one. And you take that against your tax liability, that's $50,000, $60,000, $40,000, depending on your tax bracket, depending on your state, right? Everybody's state's different. But that could save you 40 grand in just taxes, in addition to your 10% cash on cash, in addition to your pay down, in addition to your appreciation, which means that 80, 90, 100 grand you put down, you could end up getting almost all of that back on year one. And when you can figure out that game as a real estate professional and a real estate agent, that's when you realize the bounds are limitless. So hopefully this was helpful today. It's actually ran probably a little longer than most of our videos. Hopefully I didn't lose anybody. And I know this kind of starts at a 101 on analyzing deals, and it gets a little bit complicated towards the end. So if you have any questions, if you have anything about what I talked about that you want clarification on, if you want to see what my numbers look like on any of the deals I've bought, whether it's the single families, whether it's our flips, because we really talked about rentals today. We'll do another video on analyzing flips at some point. Feel free to reach out to me. Again, my Instagram's in the comments below in the description. It's Jared Davis RE. You're welcome to even set up a Zoom call with me. It's linked in my Calendly on Instagram. And again, please like, subscribe, share, and we'll see you again on our next video of Mega Agent Academy.